Welcome to the channel, I'm James, and today we're going to look at Apple Inc., ticker symbol AAPL. They just had earnings yesterday and they had an absolute crazy first quarter. All-time records, revenue up 11%, 123 billion. We'll be going through the actual financial statements, then giving an updated discounted free cash flow model and a Buffett Grimm intrinsic value model, so that I'll be giving you the fair value of Apple based off their most recent earnings. So this is brand new. I don't think anyone has these out yet. So let's have a look at Apple's price right now. $167.79. Up overall the year at about 22%. It's had a strong rebound and it's almost back to its all-time high, which was at 182. So it's made a strong move up on the day. I think it's up almost 5% and still climbing. So is this a good time to buy? So let's have a look at, firstly, we'll go to my steps. So is the PE ratio less than the market? No, market is actually a bit lower than it is, 24, and Apple has a PE ratio of around about 30. So that is a fail, but other than that, everything else is going to be looking great. So has the revenue increased over the last 5 years? Yes, it's gone from 265 billion to 378. So that is a massive pass there. And if we go to the net sales or the revenue here, this is the 3 months ended. So products and services are the ways this is split, and they made 104 billion in products alone, and services was 20 billion, which gives you 123 for the quarter. Compared this to last year, which was 111, that is up massively. So that is an excellent thing to see. And if we just scroll down a little bit here, you will see how this is split out. The net sales by category are iPhone, Mac, iPad, wearables and home accessories, and services. You can see iPhone is the bulk, 71 billion up from 65. Then next is services with 19.5 billion up from 15.6. And then I would have thought it was the Mac, but you can see wearable home accessories, 14.7 billion up from 13. Then the Mac, which is 10.8 up from 8.6. And then iPad is actually down 7.2 to 8.4, but everything else is up dramatically. So next, what we're going to be doing is looking at the profit, and the profit for Apple has gone up once again from 60 billion to 100 billion. So that is a massive pass. And you can see here that the total cost of sales was 69 billion, which gives a gross margin of 54. And then the net income for the quarter was 34 billion, which is once again up from 28. And if we add the 3 quarters, the 4 quarters together, add this to the previous 3, that will give you $100 billion in profit. Next, are the shares outstanding decreasing? Yes, Apple have a share buyback program and they are buying back their shares, 19.8 billion to 17.3. It doesn't mention the share buybacks here, but Apple had consistently been buying back shares, so that's why it is a pass. Next, free cash flow, 64 billion to 101 billion. We will go back to the statements here and see how we have calculated. So they do have their cash flow statements here, and what we want to do to get free cash flow is cash from operating activities minus capital expenditures, and capital expenditures here are payments, acquisitions for properties, plants and equipment. So cash flow from operating activities has gone up from 39 billion to almost 47, and capex is down. So that gives you a free cash flow of, well, 47, take away that, which is around about 44 billion. And if we add that to the previous 3 quarters, that gives you 100 billion in free cash flow. So what is that? 4 passes, 1 failure. Even with a massive market cap of 2.7 trillion, because they have 100 billion in free cash flow, they have a pretty good free cash flow ratio of 26.9, down lower than the PE market. PE ratio, sorry, not the PE market, and the dividend is very safe, 16 billion to 100 billion. So this is 4 passes. PE ratio is a little bit high, free cash flow ratio is lower, and everything else is trending upwards. Now we're going to look at discounted free cash flow and the Buffett Grimm intrinsic value. So firstly, we've calculated the future free cash flows. This will be on the first one, where you can see that the next year's of free cash flow is actually estimated down from 2021. So a little bit on the conservative side. This actually has Apple undervalued at the minute. It's got a calculated stock price of $173.35, which means it's slightly undervalued at the minute, but that is with it being a bit more consistently. If Apple were able to break 2022, then that would have Apple at $220 a share. So you can see that these numbers aren't particularly bullish, but still it shows that Apple, even on discounted free cash flow for a massive tech company and still a growing company, it's still undervalued from discounted free cash flow. Next, this is the one I like. Buffett Graham intrinsic value takes earnings per share and expected growth rate into account. Apple's earnings per share is $5.61, and the expected growth rate is 14%. And what does that give a fair value of? $208.80, which is a 24% discount. So both of these models are a buy. If we're a bit bullish on the discounted free cash flow, you can see that we're actually close to the Buffett intrinsic value calculator. But even then, both models said it was undervalued, so it's looking like a buy based off these earnings, and Apple are going from strength to strength. Right, guys, thanks for watching. Please give a like on the video, and I'll catch you guys next time.